The Federal Reserve hiked interest rates to crush inflation. That's what they do. Raise rates, kill demand, cool the economy, bring prices down. And historically, when rates go up, gold goes down. It's one of the most reliable correlations in finance. For 40 years, it worked like clockwork, except this time, it didn't. Gold hit all-time highs. While the Fed was tightening, gold was rallying. The lever they've relied on for decades, the one that's supposed to control everything, just stopped working. This isn't a glitch. This is a structural break in the global financial system. The Fed didn't lose control because they made a mistake. They lost control because the rules changed underneath them. We're going to follow the fingerprints. We're going to look at who's actually setting the price now. And the answer isn't in Washington. It's in Shanghai, Delhi, and Moscow. Let's start with the crime scene. For 40 years, gold and real yields moved in lockstep. Real yields up, gold down. Real yields down, gold up. It was almost mathematical. You could chart it. Nearly a one-to-one inverse relationship all the way through 2020. The mechanism was simple. When real yields rise, the opportunity cost of holding gold increases. Gold doesn't pay interest, so investors rotate out of it and into bonds. The Fed controlled the interest rate lever, and through that lever, they controlled gold. Then 2022 happened. The Fed raised rates aggressively. Real yields spiked above 2%. By every historical measure, gold should have collapsed. Instead, it bottomed at $1,620 per ounce in September 2022, then rallied to over $2,400 by 2024. The math stopped working. The correlation that had held for 4 decades just died. This wasn't noise. This was a regime change in how the metal gets priced. Now, here's the tell. While gold was rallying, Western gold ETFs, GLD, IAU, the big ones, saw massive outflows. Investors were selling. Institutions were rotating out. On paper, demand was falling. But the price kept climbing. That's not supposed to happen. When demand falls, prices fall. Except the demand wasn't falling. It was just moving. The West was selling paper. The East was buying metal. Look at the data. Central bank gold purchases hit record levels in 2022, 1,136 tons. That's not normal accumulation. That's a structural shift. China, Russia, Turkey, India, relentless buying, no pause for rate hikes. They didn't care what the Fed was doing. They had their own agenda. The Shanghai Gold Exchange tells the story. Physical withdrawals exploded while COMEX inventory stagnated. Price discovery was moving. The East wanted the metal. The West was trading the paper. 2 different markets, 2 different motivations, 2 different outcomes. Then there's the ruble gold episode in 2022. Russia briefly pegged gold at 5,000 rubles per gram. It didn't last long, but it sent a signal. Sovereign buyers were setting a floor. They were telling the market, we will buy at this price and we will keep buying. The plumbing shifted. London OTC liquidity started tightening. Premiums in Asia spiked. Meanwhile, back in the US, the Mint reported sales levels not seen since Y2K. Retail demand surged. One Gold, the APMEX subsidiary, reported record sales, $265 million in March 2022 alone. So while Western institutions were dumping paper, retail and sovereigns were stacking physical. The basis and arbitrage signals confirmed it. Gold futures were trading at persistent backwardation in certain markets. That's the fingerprint of a supply crunch. When futures trade below spot, it means people want the metal now, not later. This is the crime scene. The Fed raised rates. Real yields spiked, and gold rallied anyway. The lever broke because the game changed. The question isn't when gold will correct. The question is, who controls the price now? So if the Fed's lever is broken, who's setting the price? Follow the metal. Follow where it's actually moving, not where the headlines say it's moving. And what you'll find is a silent capital flight from west to east that's been accelerating since 2022. Central bank gold purchases aren't just high, they're structurally high. 1,136 tons in 2022. Over 1,000 tons again in 2023. That's more than double the pre-2022 average of 400 to 500 tons per year. This isn't a spike. This is a new baseline. And the buyers, China, Russia, Turkey, India, Poland, Singapore, emerging markets, non-Western central banks, relentless accumulation, month after month, with no pause for Fed policy. Now look at where the metal is going. The Shanghai Gold Exchange. Physical withdrawals exploding. COMEX inventory? Stagnant. Flat. The West's paper market is still the largest by notional value, but the physical market is setting the floor. When Shanghai bids, they're bidding for the actual metal. When COMEX trades, it's derivatives, contracts, promises to deliver, two completely different animals. Price discovery is moving east. That's the structural shift. It's not that the West doesn't matter anymore. It's that the East now has veto power. If Shanghai wants metal and COMEX tries to suppress the price, the arbitrage opportunity gets exploited immediately. The basis tightens, premiums spike, the paper price gets pulled back up. Let's talk about the 2022 ruble gold episode because most people missed what it actually meant. Russia announced they'd buy gold at 5,000 rubles per gram. It didn't last long, maybe a few weeks, but that wasn't the point. The point was the signal. Russia was telling the world, we will set a floor, we will buy at this price, and if you try to push it lower, we'll just buy more. That's sovereign price setting. That's not speculation. That's policy. And it's not just Russia. China's been doing the same thing, just quieter. No announcements, no press releases, just steady, relentless buying through the People's Bank of China. They added roughly 350 tons between 2020 and 2025. That's official data. The unofficial number? Probably higher. Now, the plumbing. London OTC liquidity, tightening. Premiums in Asia, spiking. The vaults are telling a different story than the futures market. London vaults seeing net outflows. Zurich and Singapore seeing inflows. The metal is leaving the traditional Western custody system and moving into non-Western vaults. That's not a short-term trade, that's a long-term reallocation. Meanwhile, back in the US, retail demand surged. The US Mint reported gold sales at levels not seen since Y2K. One Gold, the APMEX subsidiary, did $265 million in sales in March 2022 alone. Record month. And this is happening while Western institutions are selling paper ETFs, GLD, IAU, massive outflows. But retail, stacking physical, the basis and arbitrage signals confirm the supply crunch. Gold futures trading at persistent backwardation in certain markets. That means the spot price is higher than the futures price. That's rare. That's the market saying, I want the metal now, not later. I don't trust the promise. I want the asset. This is the fingerprint of a physical shortage masked by paper abundance. The COMEX can print contracts all day long. But if no one wants the contract, if everyone wants delivery, the system breaks. And we're getting closer to that breaking point. So the Fed lost control because the demand shifted. It's not coming from the West anymore. It's coming from sovereigns who don't care about real yields. They care about neutrality. They care about reserves that can't be frozen. They care about assets with zero counterparty risk. And that's gold. February 2022, Russia invades Ukraine. The West responds with sanctions, and overnight, $300 billion of Russian foreign reserves vanish, frozen, gone, not destroyed, just inaccessible, held in Western banks, denominated in dollars and euros, and suddenly treated as conditional assets instead of sovereign property. That was the moment everything changed. Every central bank on the planet watched that happen and asked the same question. Could that happen to us? And the answer, for most of them, was yes. If you hold your reserves in dollars, if you custody them in New York or London, they're not really yours. They're yours as long as the US says they're yours. That's the new reality. Dollar reserves are conditional, not guaranteed. This isn't speculation. This is visible in the IMF COFR data, currency composition of official foreign exchange reserves. You can track it. Central banks have been quietly diversifying away from treasuries and into gold, not all at once. Not with announcements, just steady rebalancing. A few percentage points here, a few tons there, but it adds up. Now, think about the math. Global foreign exchange reserves total roughly $12 trillion. If central banks shift just 5% of that from dollars into gold, that's $600 billion of demand. At current prices, that's roughly 7,500 tons. For context, annual global gold mine production is around 3,500 tons, so a 5% shift would absorb more than 2 years of global supply. And we're already seeing purchases north of 1,000 tons per year. The shift is happening. Gold is the only Tier 1 asset with zero counterparty risk. It doesn't depend on a government's promise. It doesn't require a legal system to enforce it. It just is. You hold it, you own it. No intermediary, no counterparty, no political risk. In a $34 trillion debt world where currencies are being weaponized, that matters. The sanctions regime created a structural bid under gold that interest rates can't override. The Fed can raise rates to 5%, 10%, doesn't matter. If you're a central bank in Beijing or Delhi or Ankara, your calculus isn't about yield anymore. It's about return of capital, not return on capital. It's about making sure your reserves are actually yours when you need them. This is the shift from trust-based reserves to possession-based reserves. For 70 years, the global system ran on trust. You trusted that your dollar reserves were safe. You trusted the legal framework. You trusted the institutions. That trust is breaking. Not completely, not everywhere, but it's cracking. And once that crack appears, it doesn't heal. It widens. The vault anomaly confirms it. London vaults, net outflows. Zurich and Singapore, net inflows. The metal is leaving the traditional Western custody system. It's being repatriated. It's being moved to jurisdictions that central banks control directly or trust more than they trust New York and London. The plumbing is rerouting. This isn't a temporary reaction to one geopolitical event. This is a structural reallocation driven by a fundamental reassessment of what safe means. The Fed lost control of the price because the Fed lost control of the narrative. Gold isn't a speculative trade anymore. It's insurance. It's the apex predator of assets in a weaponized currency system. And no amount of rate hikes can change that. The COMEX trades over 500 tons of paper gold every single day. Every day. 500 tons of contracts changing hands, bids and offers. Price discovery happening in real time. Sounds like a deep, liquid market. Except here's the problem. There's only about 10 tons of physical gold actually sitting in COMEX vaults available for delivery. That's a 50-to-1 ratio, 50 paper claims for every ounce of deliverable metal. Now, historically, this worked. Most contracts settled in cash. Traders didn't want the metal. They wanted exposure. They wanted to speculate on the price. So the system functioned as long as everyone agreed to play the paper game. But that agreement is breaking down. Delivery notices are spiking. Vault inventories are draining. Premiums are widening. The people taking the other side of these contracts? They're not rolling them over anymore. They're standing for delivery. They want the metal. Compare that to the Shanghai Gold Exchange. Completely different structure. Mandatory physical settlement. When you buy a contract on the SGE, you're buying the metal. Not a derivative. Not a promise. The actual asset. And when the East bids, they're bidding for that metal. They're not playing the leverage game. They're playing the accumulation game. This is the core issue. The Fed's influence was always over the paper market. Futures, ETFs, swaps, that's where they had control. They could expand open interest, absorb demand, suppress price. But physical demand sets the floor. And paper shorts can't suppress it anymore because the physical buyers don't care about the paper price. They care about the metal. There's a historical parallel here. 1971. Nixon closed the gold window. Why? Because foreign central banks were demanding physical delivery of gold in exchange for their dollars, and the U.S. didn't have enough gold to meet the demand. Physical demand overwhelmed the paper promise. The system broke. We're seeing a similar dynamic now. Just in the private market instead of the official one. The COMEX is the modern gold window, and the cracks are showing. Think of it like a rubber band. You can stretch paper pricing away from physical reality, but only so far. The further you stretch it, the more tension builds. And when it snaps, the repricing is violent. We may be in the early innings of that snap. The institutional tell? JP Morgan's vault holdings doubled while they were shorting futures. Read that again. They're holding more physical gold than they ever have while simultaneously betting against the price in the paper market. They're hedging both sides. They're shorting paper while stacking metal. That's the clearest signal that the smart money knows the correlation is dead. They know the paper game is ending. They're positioning for the snap. They're not trusting their own shorts. They're buying insurance in the form of the actual asset. The leverage ratio can't hold forever. 50-to-1 works when no one wants delivery. It breaks when everyone does. And right now, the trend is clear. More delivery requests. Fewer rollovers. Tighter spreads between spot and futures. The market is telling you. The metal matters more than the contract. The Fed can still move the paper price. They can still coordinate with bullion banks to expand open interest, create selling pressure, shake out weak hands, but they can't control the physical bid. They can't print gold. They can't force sovereign buyers to sell, and that's why they lost control. Gold is transitioning, not from one price level to another, from one category to another. It's moving from speculative commodity back to reserve asset, and that shift is structural, not cyclical. Basel III regulations, implemented in 2022, classified gold as Tier 1 capital, same tier as cash, same tier as government bonds. This wasn't symbolic. This was the global banking system officially recognizing that gold functions as a monetary asset, not just a traded commodity. Banks can now hold gold on their balance sheets at full value with zero risk weighting. That changes the incentive structure. That changes how institutions think about allocation. The Fed can print dollars. They've proven that repeatedly. $4 trillion to $9 trillion in 2 years during the pandemic. $700 billion in QE announced in March 2020. Rates cut to zero. The printing press works, but they can't print gold, and the world is remembering that. The interest rate lever only works when trust in the currency is intact. When that trust fractures, the lever stops functioning. You can raise rates to 5%, but if inflation is running at 7 or 8% in real terms, not the CPI fiction, the actual lived experience, then real yields are still negative. Gold doesn't care about nominal rates. It cares about purchasing power erosion. And right now, that erosion is accelerating. Mike Maloney predicted this in his work years ago. QE infinity, helicopter drops, bailouts, we're already seeing it. The Fed's balance sheet exploded. The next phase? More of the same, but faster. If the Fed pivots to cuts or pauses, gold will likely accelerate. But even if they don't, the physical bid from the East provides a structural floor. The system is bifurcating. The West still plays the paper game. The East plays the physical game. The macro setup is clear. Inflation is structural, not transitory. Debt is unsustainable at $34 trillion and climbing. Currency debasement is accelerating. The M2 money supply is up 40% in 4 years. Gold noticed, the market noticed, and the central banks noticed. Gold doesn't need a crisis to rally anymore. It just needs the current trajectory to continue. More debt, more printing, more weaponization of reserves, more distrust in the plumbing. That's the baseline scenario. And in that scenario, gold isn't speculation, it's the anchor. The Fed lost control because the rules of the game changed underneath them. For decades, they controlled the narrative. They controlled the lever. They controlled the price through the paper market. But the physical market has veto power now. And the physical market doesn't answer to the Fed. It answers to sovereigns in Beijing, Delhi, and Moscow who are buying for reasons that have nothing to do with interest rates. This is the return of gold as money, not officially, not in the monetary system, but functionally. In the way central banks allocate reserves, in the way institutions hedge risk, in the way individuals protect wealth, gold is being re-rated, and that re-rating is just beginning. The Fed's interest rate lever is broken because the trust in the plumbing is broken. Gold is no longer a speculative bet. It's a structural hedge against a weaponized dollar system. The smart money is following the metal, not the headlines. Track these signals: Shanghai withdrawals, central bank purchases, COMEX inventory, vault flows. The math doesn't have an agenda. It's telling you the system is repricing risk. Stay liquid, stay disciplined, and watch the plumbing, not the theater. I'll see you in the next briefing.